Hey everyone, and welcome to this explainer. Today, we're unpacking a very specific and honestly super exciting set of data. We're looking at the Kingfinity Dividend Calendar for the week of July 28th to August 3rd, 2026. Now, this is shaping up to be an incredibly powerful transition week. Think about it. We're literally watching the final cash flow doors of July close right as the August dividend window swings wide open. So let's dive into the data together and see if we can separate the true structural signals from all the market noise.
Okay, let's dive right into this. Here is our roadmap for today. We'll start with Welcome to the Kingdom, move into the dividend watch list, and then run a sector stress test. After that, we'll weigh the strongest versus weakest signals and wrap it all up with the Kingfinity vision.
Welcome to the kingdom. First things first, to give us some context, we're operating with a massive model portfolio value of 2 million euros. Now, establishing these macro stakes right at the top is absolutely crucial before we zoom into the localized data. It sets a baseline of credibility, right? We aren't just blindly chasing random yields here, we're analyzing a sizable, highly structured machine. Now, what's really interesting about this setup is that this 2 million euro portfolio generates an estimated annual dividend of 99,862 euros. That's nearly 100 grand. It breaks down to an average monthly cash flow of over 8,300 euros. That right there represents real, disciplined cash flow over market hype. The portfolio pays, and it pays consistently because of careful structuring.
Moving right along to Section 2, the dividend watch list.
When we look at the ex-dividend landscape for this week, it is an incredibly wide decision field. We're spanning everything from payroll services with Paychex at $1.19 to the semiconductor space with Texas Instruments at $1.42, and then major financials like Morgan Stanley at $1.15. You've also got AGNC and Alliant Energy in the mix. But remember, the strategy here isn't to just indiscriminately chase every single dividend we see. It's to actively observe which of these cash flows are actually supported by quality, fortress-like balance sheets, and repeatable earnings power.
Shifting gears to the actual payment side. This is the fun part, right? This is where highly visible, realized cash flow actually hits the accounts. We've got major institutional names dropping payments this week. JPMorgan is paying out $1.50 per share, EOG Resources at $1.02, Mid-America Apartment Communities at $1.53, plus huge reliable staples like Verizon and Bristol Myers Squibb. This is exactly where long-term discipline transforms into tangible, spendable income.
All right, Section 3, Sector Stress Test.
To make sense of all this, the model breaks the week down into 3 distinct sector worlds. First up, the strongest cluster is financials and REITs, which makes this week heavily weighted in rate-sensitive assets like JPMorgan. Second, we're seeing strong defensive signals coming from utilities, telecom, and healthcare, names like Alliant Energy that really represent that essential service dividend logic. And third, we have cyclical signals from energy and industrials, like EOG Resources, which naturally depend heavily on commodity cycles and broader economic activity.
So the crucial point is, this is not just your standard run-of-the-mill dividend week on the calendar. Not at all. It's a fundamental stress test of income quality across these 3 totally different worlds. We are actively stress testing regulated cash flow, financial balance sheets, and rate-sensitive real estate just to make absolutely sure our income remains resilient regardless of what the broader market is doing.
Section 4, Strongest versus Weakest Signals.
And this brilliantly illustrates the discipline we've been talking about. Let's pit 2 very different signals against each other. On one hand, you have Morgan Stanley raising its dividend to $1.15. That is a massive signal of systemic confidence. It shows serious earnings capacity and incredibly strong capital levels from a major financial institution. But then, contrast that with AGNC. They're offering a high-yield mortgage REIT structure at 12 cents. But here's the catch. That double-digit yield depends heavily on funding costs, spread income, and massive leverage. One of these is supported quality, the other is highly vulnerable to interest rate volatility.
Which leads us directly to this foundational view, and it's one of my favorites. A high yield is not automatically a crown. Sometimes it is just a warning flag wearing gold. A dividend increase from a systemically important financial powerhouse carries significantly more weight than a dangerous headline yield that could just instantly collapse under balance sheet pressure.
Finally, Section 5, the Kingfinity vision.
So I want to ask you directly, how does a disciplined observer actually navigate this? With such an incredibly busy week of payouts and ex-dividend dates spanning so many sectors, how do you extract real, lasting value without getting burned by high-yield traps?
let's move to and see how this builds. Because inside this framework, it really comes down to three foundational questions for every single asset. 1. Is the dividend backed by recurring business strength? 2. Is the yield high because of fundamental strength, or is it just because the market is demanding compensation for immense risk? And 3. Does this asset actually strengthen our overall portfolio balance, or is it simply increasing our concentration pressure in rates, credit, or a specific sector?
Now, as we get closer to the KFX Genesis launch on October 7, 2026, we have to ensure total structural clarity about what we are building here. KFX is a digital community and an ecosystem participation layer built around this very vision. It is explicitly not equity, it is definitely not a dividend right, and it is not a claim on portfolio cash flow. It is entirely about cash flow transparency, discipline, and long-term observation.
We'll wrap up this explainer on this undeniable truth. Cash flow is not hype. Cash flow is discipline. So as you look at your own portfolio moving from July into August, I really want to leave you with this provocative question to chew on. Are you chasing the hype of a warning flag wearing gold, or are you building the discipline of lasting, repeatable cash flow? Thank you so much for walking through this explainer with me, and hey, stay disciplined out there.